believe, and I may be wrong, by the way, but I believe, and I've told you before, and I've told your audience before, that I believe the US dollar will decline in terms of its purchasing power, its absolute purchasing power, by 75% over 10 years. It's done a pretty good job since I started making that prediction, by the way. And if I'm right, by the way, that happened in the decade of the 70s. The US dollar, according to the Office of Management and Budget, lost 75% of its value in 10 years, meaning that what bought you $1,000 worth of goods and services in 1970 cost you $4,000 in 1980. Not coincidentally, during that decade, the gold price ran 26-fold. I don't believe that the gold price runs 26-fold from here. It's already up almost 20-fold from from the year 2000. But suffice it to say, I suspect the nominal price of gold will do fairly well in the next 10 years. If I'm correct, the earnings attributable to the gold mining sector will do very well, very, very, very well. And what's interesting to that is that in terms of your entry point today, you aren't getting a great price, but you're getting a fair price. Buffett has taught us that paying a fair price for a great industry is a really good deal if the outlook for that industry is strong. And I see opportunities across the board. I see risks too. One risk is that we as gold investors, conditioned by the idiotic performance of gold mining company managements 20 years ago, have insisted that our companies be too parsimonious with regards to their reinvestment in their own business, insisting on share buybacks and higher dividends. This has come at a price. The industry is much more efficient than it used to be. It needed to be much more efficient than it used to be. But the industry has underinvested in terms of exploration and new project development. So we are going to face a problem in many companies with declining output. There's an opportunity there because the way the Newmonts of the world and the Barricks of the world are going to deal with declining output is to buy other gold miners. This is going to happen for sure. And it's not going to happen just from bigger companies taking over little companies. You're going to see more sideways mergers or smaller companies taking over even smaller companies or multi-asset producers taking over single asset producers. The acquisition the other day of Orla by Equinox is a prime example of this trend. Companies that become bigger, have higher market capitalizations, have more trading liquidity, and hence have a lower cost of capital as they encourage, as an example, ETF and index buying. This will occur really throughout the sector. If somebody pays attention to the equity prices of the gold mining companies on a Friday, God help them. You need to pay attention, A, to the relationship between price to value, and B, to the probability of those values increasing in the 2-year time frame or the 10-year time frame. One of the reasons why I'm not an aggressive buyer of gold equities today, given what I think they'll do, is the fact that I've been an aggressive buyer of gold equities for 10 years. I don't need more of them. And if you think in that time frame, then you begin to make money on the sector. You know, following on that line of thinking, I've been saving in gold, not just gold. I mean, I've maintained liquidity in US dollars, but I've been saving in gold since the year 2000. I reorganized much of my financial life in the year 2000. I had a sort of a come to Jesus meeting with myself in terms of how I allocated my time and capital. And as a way to sharpen my way of thinking, I began every year to, as accurately as I could, so fairly roughly, calculate my net worth, my income, my expenses in gold rather than in dollars. And Jesse, if you do that, you are struck by how cheap real estate is, by how cheap energy is, by how cheap healthcare and health insurance are, by how cheap groceries are. If you calculate those same expenditures in Canadian dollars or US dollars, you're struck by how expensive stuff is. And if you calculate that in gold terms, you're struck by how cheap that is. What's the variable? Easy. 25 years. That's the variable. So when people tell me today that the silver price fell, as an example, or the silver the Pan American silver price fell by 7%. I say, really? It depends on the period of time over which you're calculating. And that's the variable that holds most investors and speculators back from the success that they might otherwise deserve.
Let's dive into the oil and gas sector here, an area you have a ton of experience in and have been consistently bullish on in our previous conversations. Now that WTI crude has soared into the triple digits following the start of the war in Iran and the closure of the Strait of Hormuz, a lot of the equities performing very well in the aftermath of that as well. Would you still be deploying capital in the energy sector here, or is some caution warranted in case things get resolved, potentially Hormuz opening again, and perhaps that could send the WTI price back to where it was before this whole debacle began?
It depends again on who you are. If you don't have oil in your portfolio, get some. Get some. Separate and apart from the Straits of Hormuz, and Jesse, we talked about this on your show before too. The oil industry has been underinvesting between $1 billion and $2 billion a day in sustaining capital. That just got worse. None of Iran, the UAE, Kuwait, or Saudi is investing a lot right now in sustaining capital investment because they're using the money for other things, killing each other. In addition to that, the oil industry needs to replace or repair all the facilities destroyed by war. What this means is that in 2029 or 2030, irrespective of the outcome in the Gulf, that oil, at least production, will be in shorter supply, because if you don't make sustaining capital investments, you impede your ability to produce. Now, your entry point could be a problem in the near term. If peace breaks out in the Gulf, and I dearly hope it does, those cargoes which are stranded north of the Gulf that replenish world markets likely bring down the price of oil. Should another thing happen, which I hope does, should peace break out in the dispute between the Russia and the Ukraine, it would over time unleash the flow of Russian oil into world markets. That flow will be constrained because the Russians haven't been making sustaining capital investments either. They've needed the war. They've needed the money to maintain the domestic economy in the face of war. But over time, that would increase supply. But no matter what we do, the lack of sustaining capital investment and new project investment in the oil and gas market means that in the period 2029-2030, that's going to be a very, very, very good place to be. The big thinkers of the world, of course, told you for the last 15 years that peak oil demand would occur and there wouldn't be an oil market to worry about after 2030. Interestingly, those same big thinkers revised their thinking a little bit. Now they say 2065. Sort of a big difference between 2030 and 2065. Now, I remember talking to you, I don't know, January, or maybe it was even last year, talking about the fact that Exxon was a no-brainer. Now, understand, Exxon was a no-brainer at $90 or $95. At $185, it's a bit of a conundrum for somebody who already has oil and gas in their portfolio. A second opportunity that we described at that point in time, I talked about a basket of Canadian oil and gas companies, saying that the only risk that you faced was really in Ottawa. And that risk remains. But the Canadian oil companies are cheaper by any metric than the American oil companies. They have a lot more undrilled locations. They have spectacular human resources up there, but they have a problem at the top. Mr. Carney, I have chosen to studiously ignore the top-line political risk and go for value. Time will tell whether that trust in the Canadian citizenry is misplaced.
Let's talk about uranium. The equities have been incredibly volatile as of late. Again, I know that this is going back to watching day-to-day price action and instead focusing on the long-term trajectory of the sector, which I believe is very bullish. But we have seen a whipsaw in volatility, up double digits, down double digits the next day. What do you think is causing this volatility in the sector? And what are your overall thoughts at uranium at present? Do you think there's still value there when it comes to the miners?
Last question first, yes. The biggest beneficiary, economic beneficiary of the Gulf conflict will be uranium. It's worthy to note that the French nuclear fleet, the fourth largest in the world, the Japanese nuclear fleet, the third largest in the world, were constructed largely in response to the Arab oil embargo of 1973. That event refocused nations who were not energy self-sufficient on the need for a fuel that was dense enough that it could be stored domestically to fuel domestic industry. Japan noted pointedly that they could store enough uranium in one warehouse to power Japan for 5 years. They obviously couldn't store that much oil, that much gas, that much coal, or certainly that much rainfall or wind. And that lesson has been painfully relearned by the entire world recently. The upshot of that, if you combine it with the newfound political favor that uranium finds itself in as a consequence of being non-carbon generating, means that the pace of new plant construction, and in Japan, the pace of restarts, and even in places like the United States and France, the deceleration of the deactivation of plants means that the uranium business is coming into a real, true renaissance on top of what is already a production deficit. If you merge that with the potential new demand coming from, as an example, data centers, and in particular the implication of the market moving to long-term contracts rather than spot pricing, the importance of that being that producers can tell with certainty the volumes and the prices that they receive for product, unlike any other commodity in the space. And by the way, consumers, utilities can lock in the prices for long enough to build a new plant and amortize the loans. The next 10 years are going to be absolutely golden for the uranium business. Absolutely golden. Will all these things manifest themselves in 2027? Probably not. Does that matter, even to a 73-year-old? Absolutely not. Now, one needs to exercise caution in the sense that if you're an investor, there's a no-brainer, two no-brainer ways to play it. The Sprott Physical Uranium Trust, note that I'm the largest shareholder of Sprott, so I benefit from this recommendation. And Cameco, if you will, the OPEC in a wrapper of uranium. Coming down, there's probably 150 companies that purport to be uranium companies, but probably only, 15 of those are viable. So you have to select with some caution among those. But you are investing, if you found a viable company, in a sector that, absent a synchronized global depression, is a no-brainer. Truly a no-brainer.
Rick, tell us about the upcoming Rule Symposium. Talk to us about Battle Bank. Tell us about Rule Investment Media.
Love to talk about all those. As you noted, Jesse, when we were off the air, I failed retirement completely. I'm delighted about that. So let's start with Rule Investment Media. And let's personalize it. Rule Investment Media exists to educate investors about how to invest in natural resources. Labor of love for me. It's my attempt to codify 50 years of experience and make it available to investors. If you will, it's my book. And in order to induce you to do that, anyone who wants to can go to the Rule Investment Media website, ruleinvestmentmedia.com, list their natural resource stocks, and I will, for free, evaluate their portfolio, ranking them 1 to 10, 1 being best, 10 being worst, and commenting on individual issues where I think my comments might have value. Note that this service is absolutely free, which is a damn good price. The second service that we have, which is free, is the Rule Classroom, ruleclassroom.com. At the Rule Classroom, there's well over 300 hours of instructional videos, including Introduction to Natural Resource Investing, a 5.5-hour-long segment telling you how to invest in natural resources and how to do your own securities analysis. Note, this is once again free. Every Thursday, where it's possible, I spend an hour with Albert Liu or other people answering questions and answers about specific companies. Price, free.